Greetings, Dr. Zubair, Dr. Anna, and fellow classmates. My name is Yang Haibo. We are Group 5. Welcome to our financial analysis of Brite-Tech Berhad. Today, we will start with the company background, followed by our quantitative analysis, and conclude with strategic recommendations. Now, let's begin with Section 1, the research overview. We focused on Brite-Tech's 2023 edited annual report, comparing it against 2022 data to spot key trends. Our main objective is to evaluate the company from three angles: profitability for investor, liquidity and safety for creditors, and asset utilization for management efficiency. Now, moving on to Section 2, the company background. Brite-Tech is venturing in the Malayan water treatment sector, listed on the ACE market with over 35 years of history. What distinguishes them is their integrated business model. They don't just sell products, they provide complete solutions. Their business stands on two main pillars. First, the soft side, providing comic formulas and lab analysis survivors. Second, the hard side, focusing on engineering and systems construction. They also generate recurring income through their entire division. Finally, the industry context. This industry has high barriers to entry due to strict regulations by the DOE and SBAN. However, the current shift towards ESG standards works in their favors. As factories face pressure to improve water treatment, this creates a solid growth opportunity for compliant players like Brite-Tech. Now, to understand how this translates into actual numbers, I will hand it over to my teammate Xie Xiaoying to walk you through the horizontal analysis.
Hello, Doctor. My name is Xie Xiaoying. Today, I'm going to present the horizontal analysis of Brite-Tech Berhad from the year 2022 and 2023. Horizontal analysis means we compare 2 years of financial data to see whether the company is improving or getting worse. In this presentation, I will explain the change in income statement, business segments, balance sheet, and cash flow. First, let's look at the income statement. Total revenues slightly decreased by 2.16% from 25,663,000 ringgit to 25,109,000 ringgit. This means the company shows a little less in 2023. However, cost of sales dropped by 10.4%, so gross profit increased by 4.52%. This shows the company controlling its cost better, but expenses went up a lot. The financing costs also increased due to higher loans. Because of this, profit after tax decreased slightly by 2.35%. Overall, the company controlled its costs well, but higher expenses and interest reduced the final profit. Next is business segment performance. The environmental products and service segments is my business. Revenues fell a little, but segment's profit increased by more than 54%, which is very good. The equipment segments have lower revenues, but profits still increase slightly. The environment segments have higher revenues, but profit dropped by about 26%, showing weaker performance. So overall, the company still relies mainly on its environmental segments for profit. Let's look at the balance sheet. Total assets increased by 12.79%, which means the company is getting bigger. Investment property increased a lot, showing that the company invests more in long-term assets. Cash and bank balance also increased by 44%, which means the company has better liquidity. However, total liabilities increased by 25.69%, mainly due to higher loans. That means the company is using more borrowing money, which also increased financial risk. For cash flow, net cash from operating activity decreased slightly by 7.25%. This means less cash was generated from daily business, but investing activity improved because the company showed some excess and spent less on new one. Financing cash outflow also decreased, so less money was used to repay loans. As a result, cash at the end of 2023 increased by 18.74%, showing stronger cash position. In conclusion, Brite-Tech Berhad improved its cost control, gross profit, asset size, and cash position in 2023. However, reduced and final profit decreased slightly, and the company now is higher loan and financing cost. It means the company is growing, but it must carefully control its expenses and debate in the future. Thank you.
Hello, Professor. My name is Zhao Xi. This section uses common size analysis to examine how the group's financial structure and performance evolved from 2022 to 2023. Rather than focusing on absolute numbers, the analysis highlights proportional changes in costs, profitability, financing structure, and cash flow composition. This approach allows us to better understand whether performance improvements were driven by operational efficiency, financial leverage, or cash flow management. From the income statement perspective, the most important change in 2023 is the improvement in cost efficiency rather than revenue growth. Even though total revenue declined slightly, the group managed to significantly reduce its cost of sales, which directly strengthened the gross margin. At the operating level, profitability improved further as non-core operating expenses were tightened. However, higher finance costs reduced part of these gains, which explains why net profit margins remained stable instead of increasing sharply. Turning to the balance sheet, the overall asset structure remained relatively stable, with non-current assets accounting for more than 80% of total assets in both years. This confirms that the group continues to operate with a capital-intensive structure. However, a more important change can be seen on the financing side. Equity accounted for a smaller proportion of total assets in 2023, while long-term liabilities increased, indicating that asset expansion was increasingly funded through debt rather than equity. In terms of cash flow, the group's position improved noticeably in 2023. Operating activities continued to generate stable cash inflows and became even more dominant in the overall cash flow structure. At the same time, financing cash outflows were reduced. The investing activities recorded a small inflow, which together helped reverse the net cash outflow seen in 2022. Despite this improvement, the group still relies heavily on operating cash flows, making sustained operational performance critical going forward. Thank you.
Hello, Professor. My name is Zhang Qiwen, and now I talk about the Part 5 financial trend calculation and analysis. Focusing on the three key statements, the income statement, balance sheet, and the cash flow statement. Okay, now we start with the income statement. In 2023, our revenue remained stable, but we saw a notable rise in cost. The cost of sale increased by 24.65%, significantly outpacing revenue growth. This was mainly driven by higher prices of raw materials, labor, and supply chain. As a result, the gross margin narrowed slightly, with gross profit growing by 11.04%, lower than revenue growth. Pre-tax profit increased only marginally by 2.46%, while net profit declined slightly by 1.09%. Despite this, through optimizing project structures, improving operational efficiency, and leveraging economies of scale, we still achieve profit growth and maintain over profitability. This reflects our solid foundation in cost control and operational capabilities. Okay, next we're moving to the balance sheet. The company is still in an expansion phase given the capital and technology intensive nature of the environmental protection equipment industry. The growth in non-current assets likely comes from increased investment in equipment renewal, plant expansion, and technology projects. The growth in current assets meets daily operational liquidity needs. Our reliance on external funding has increased, mainly to support short-term expansion and payment obligations. Due to a conservative dividend policy and limit external equity financing, equity growth have been slow. Overall, while leverage has risen slightly, the company maintains a solid asset base and manageable solvency risk. Okay, next is the cash flow statement. Cash inflow from operations remains substantial, despite a slight year-on-year decline, indicating strong self-funding capability from our core business. Cash outflow from investing activities expanded, aligning with our growth initiatives such as the technological upgrades, capacity expansion, and strategy investments. Cash flow from financing improved significantly, with net outflow narrowing sharply, thanks to the increased financing and controlled dividend and share repurchase activities. Okay, finally, we make a summary. In terms of overall the financial performance, to the profitability, revenue grew significantly, but higher costs overall profits, leading to a slight decline in net profit and asset and capital structure. Assets continue to expand with leverage increasing moderately. And the last is the cash flow. The structure remains healthy with operating cash flow staying positive. Overall, the company's financial foundation remains stable, providing a solid basis for continued operation and development. That concludes the key points of our financial change analysis, and thank you.
Hello, Professor. My name is Guo Li. This section provides the ratio analysis of Brite-Tech Berhad, focusing on liquidity, efficiency, profitability, and growth, comparing 2022 and 2023. Okay, now let's begin. For the growth, the current ratio increased slowly from 3.86 to 3.89, and the quick ratio rose from 3.73 to 3.77, showing good short-term solvency. However, the debit to asset ratio increased, and the interest coverage ratio dropped, indicating higher financial pressure from debit. At the company level, liquidity ratio stayed very high and debit remains low, so overall financial risk is still manageable. Operational efficiency shows mixed results. The inventory turnover improved and the inventory days fell to 28.17 days, showing better inventory control. But receivables turnover days increased and the total asset turnover declined, meaning cash collection and asset utilized weakened slowly. In terms of profitable, cost control was effective. The gross profit margin increased and the operating profit margin rose. However, the net profit margin stayed almost unchanged, and both ROA and ROE declined, showing that returns didn't grow as fast as assets and equity. Regarding growth, the performance was weak. Group revenue declined, and the net profit growth remained negative, mainly due to weaker market demand, not loss of competitiveness. In conclusion, Brite-Tech Berhad maintains strong liquidity and stable profitability, but face pressure from slower growth, rising leveraging, and lower efficiency. Thank you.
Hello, Professor. My name is Zhang Yue.
Next, I will analyze the company's operating performance in 2023 from the aspects of overall operating performance, profitability, financial structure, and future challenges. From the perspective of overall operating performance, the fluctuations in the company's performance in 2023 were mainly due to the decline in overall market demand rather than a loss of market share. Although full-year revenue saw a slight year-on-year decrease, the company's core customer base and market foundation remained stable. Regarding revenue performance and market position, the company did not show any obvious signs of customer loss or weakened competitiveness. The decline in revenue this period reflects more the contraction in demand across the entire industry than a problem with the company's own operating capabilities. From the perspective of profitability analysis, the decline in the company's pre-tax and after-tax profits was basically consistent with the change in revenue, indicating that the decline in profitability was mainly affected by the revenue side. This shows that the company is relatively mature in terms of cost control, pricing power, and project execution efficiency. Inventory levels remain stable during the reporting period, with no significant impairment risk, reflecting that the company's inventory control and production planning were relatively reasonable. The company's working capital is of good quality, its accounts receivable and the inventory management is effective, and its risk control capabilities are strong, providing strong support for operational stability. In summary of core strengths, the company possesses a stable core business structure and sustainable revenue streams. Its profitability is relatively stable, and its cost control capabilities are strong. Its asset liability structure is reasonable, and its overall financial security is high. At the same time, the company's operation and management are standardized, and its risk control system is relatively mature. Of course, the company also faces certain challenges. On the one hand, revenue growth momentum remains insufficient. On the other hand, industry competition continues to intensify, putting some pressure on profit margins. Furthermore, the revenue structure is relatively concentrated, and there is still room for improvement in business diversification.
Hello, Professor. My name is Li Jieying. This chapter introduces strategies to improve the company's financial performance over the next 5 years. The goal is to improve performance while keeping financial stability. Overall, the company has a stable financial structure and a low risk. Profitability is relatively stable under market pressure. However, the company mainly relies on cost control and internal efficiency. Revenue growth and long-term growth are still limited. In 2023, revenue declined slightly, but profit margins improved because of cost control. This shows that profit growth comes mainly from internal efficiency, not sales growth. Therefore, the company should focus more on improving profit quality and increasing high-margin activities. Inventory management has improved, but receivables turnover and stock turnover are still under pressure. Working capital limits cash flow in the short term. The company should improve receivables collection, project efficiency, and use information systems to export operations. The company has low leverage and strong liquidity, so financial risk is low. However, financing costs are rising and ROA and ROE are declining. This means capital efficiency needs improvement. The company should use long-term financing carefully while keeping financial stability. Revenue and profit growth face pressure, and the company depends on limited revenue sources. In the future, the company should develop new revenue drivers. Compared with asset-heavy expansion, strategic partnerships are a better choice. Overall, this strategy aims to improve long-term performance with controlled risk. Thank you for listening to our report.